Welcome to Spiedel's California Minute. I'm your host, Catherine Zidane. This week we're covering what to do when an estranged spouse won't provide the required tax information. Sign up for Spiedel's Community Property Tax Issues webinar on October 6th and learn what is and is not community property, how to split community income, when community ends, and more. To register, go to spiedel.com and click webinars. An all too common issue arises when a taxpayer divorces in 1 year but still has to file a return with their ex-spouse for the prior year when they were still together, or when the community ends mid-year. Frequently, the ex-spouse does not want to provide any information about their earnings or wages. In some divorces, there can be a long period after the couple is separated before the assets are split. Keep in mind that community assets will continue to generate community income during this period. Generally speaking, difficulty in acquiring records is not reasonable cause for failing to file a return or reporting income on a return. However, IRC Section 66 subsection B provides an exception to the general rule that community income is taxed 1/2 to each spouse. IRC Section 66 subsection B authorizes the IRS to disregard community property laws by denying the benefits of income splitting between the spouses if one spouse acted as if they were solely entitled to certain income and failed to share information about that income with the other spouse before the due date of the return. Only the IRS can invoke IRC Section 66 subsection B. It's not a relief provision that can be invoked by a taxpayer to escape liability. Treasury Regulations Section 1.66-2 subsection B states that community income may be treated as separate property income if all of the following conditions are met. The spouses are married to each other at any time during the calendar year. The spouses live apart at all times during the calendar year. The spouses do not file a joint return with each other for a taxable year beginning or ending in the calendar year. One or both spouses have earned income that's community income for the calendar year, and no portion of the earned income is transferred directly or indirectly between the spouses before the close of the calendar year. Also, IRS Publication 555 states that a taxpayer is not responsible for the tax relating to an omitted item of community income if all of the following conditions are met. They didn't file a joint return for the tax year. They didn't include the item of community income and gross income. And the item of community income not included in the taxpayer's gross income is one of the following: wages, salaries, and other compensation their spouse received for services they performed as an employee, income their spouse derived from a trade or business they operated as a sole proprietor, their spouse's distributive share of partnership income, income from their spouse's separate property other than income described here, and any other income that belongs to their spouse under community property law. To escape responsibility, the taxpayer also has to establish that they didn't know of and had no reason to know of the community income, and that under all facts and circumstances, it wouldn't be fair to include the item of community income in their gross income. Many taxpayers who are separated from their spouses may not be able to establish that they didn't know of and had no reason to know of the community income, especially if their current or former spouse has continued working in the same job or continues to hold the same business or investment property held in prior years. If this happens, we recommend that the taxpayer file a return and either omit the ex-spouse's income or make their best estimate of their share of the community income and attach a statement to the return explaining the situation. It's also important to determine when the community ends in divorce scenarios. For example, in California, only income from the period prior to the date of separation is reported as community income. Frequently, the community ended far before the divorce decree was in place. If the community ended, the taxpayer is not responsible for reporting their spouse's income on their separate return for the period commencing with the date the community ended. Spiedel's California Tax Letter is a monthly newsletter that will ensure both you and your clients are up to date with California tax law changes. You can get subscription details and download a sample issue at spiedel.com under Publications. That's all for this week. Join us next time for another episode of Spiedel's California Minute.